If you're retired or contemplating retirement, you've likely heard of RMDs, or required minimum distributions. But what are they and what does it mean to you? Hi, I'm Jared with Carlin Financial Group. For the best retirement information and to help make sure you don't outlive your money, be sure to subscribe to our channel and hit the bell to be notified when we release new videos. Many of the investment vehicles that most people have used to save for retirement are designed to encourage people to save their money by giving them an incentive to defer taxes on their current income. The more they contribute to these retirement plans, such as 401ks, 403bs, and sometimes even traditional IRAs, the less income they may have to report on their annual tax return. Those investments then grow via capital gains that are also tax deferred until withdrawals are made. However, as we're all probably aware, the Internal Revenue Service plans on getting those tax revenues eventually, and typically on a larger balance that's been growing unencumbered for many years. The IRS even imposes what's known as required minimum distributions, or RMDs for short, each year starting at a certain age, to ensure that the deferred income and capital gains begin generating tax revenues for the government once the account owner is in retirement. Beginning in 2020, the age to begin taking RMDs rose from 70 and a half to 72 years old. There is a chance that under recently proposed legislation that the beginning age for RMDs could increase even more over the coming years, but we'll have to wait and see if that happens. As you can tell, we are in a time when changes to RMDs are being actively discussed, so it's important to stay up to date and make sure you are fulfilling your obligations without having to pay any unnecessary taxes. Under current law, once an account owner turns age 72, they have until April 1st of the following year to take their first RMD. In subsequent years, RMDs must be withdrawn before December 31st. Also note that the account owner is always free to withdraw more than the minimum required amount, but cannot take less without incurring penalties. Something else of note, not only did Congress raise the age at which RMDs must begin, but the IRS recently made adjustments to the Uniform Life Table. This table is established by actuaries who make an assumption about how long the average person will live based on the age they've attained. These assumptions are updated periodically to reflect gradual increases in overall life expectancies over time, facilitated by advances in medicine and healthier living trends. The most recent update to this table at the time of filming was established pre-pandemic, and the timeline for adopting the new table was scheduled to take effect this year in 2022. Fortunately, the updated table represents good news for retirees who don't need a large portion of their retirement funds to maintain their current living expenses. The lower RMD amounts mean that more of your assets have the opportunity to continue to grow with a lower annual tax bill. Retirees who do need substantial withdrawals from retirement plans are largely unaffected, since they'd likely be taking larger distributions from these accounts anyway. Using the current RMD table to determine your life expectancy factor, along with your age and your year-end account values from the previous year, you can calculate the minimum amount you will be required to distribute. We'll dig into the actual calculation and provide you with an example of how that could work in our next video, so keep an eye out. But the basic idea is that because your life expectancy decreases every year, the percentage of your assets that must be withdrawn each year increases accordingly. Another important thing to note is that not everyone will necessarily use the same table to determine their RMDs. For example, if you're married to someone 10 or more years younger than you, and that person is your sole primary beneficiary, then a different table, the Joint Life and Last Survivor Expectancy Table, must be used. This table cross-references the age of both spouses to determine a different divisor for the two ages versus the standard table based only on the account owner's age. RMDs could also exist for beneficiaries to whom you leave these accounts. Rules for beneficiaries regarding potential RMDs differ based on the status of the beneficiary. For example, a spouse, minor child, or disabled beneficiary will have different rules than other non-spouse beneficiaries. But the one hard and fast rule is this: before the account is transitioned in any way, if an RMD is scheduled for the year of the original owner's death, the beneficiary must withdraw the RMD amount, if not already distributed, for that year. Once that's done, the rules vary, but beneficiaries should investigate the specifics before making any financial moves. Finally, I'd like to leave you with a few tips regarding RMDs that may or may not pertain to you, but might be helpful and good to know in case you need to investigate further. You can take your annual RMD in a lump sum, as needed, or in monthly or quarterly payments. If you delay taking your RMD until year end, your money will have more time to grow tax deferred. If you work and contribute to a retirement plan sponsored by your employer, and you don't own more than 5% of the company, you are not required to take RMDs from that particular account until you stop working for that employer. However, you must take RMDs from any other 401k, 403b, or traditional IRA accounts you own. If you have multiple IRAs, including SEP and simple IRAs, you may take their combined RMD amount from any one of those accounts or any combination you choose. If you have multiple 403b accounts, the same applies. However, if you have multiple 401k accounts, you must withdraw RMDs from each account subject to the rules. Another note, married couples cannot aggregate RMD amounts and withdraw them from one or the other's account. Inherited IRA RMD amounts may not be aggregated either, unless you have multiple IRAs inherited from the same decedent. RMDs do not apply to Roth IRAs, as the original contributions were already taxed. RMD rules for retirement accounts can be complex. If you don't fall under one of the simpler scenarios, especially as a beneficiary, it's a good idea to get professional advice. If you'd like our help, you can learn more about working with us and apply to become a client using the link below. We thank you for spending some time with us today and hope that this information has been of value to you. Be sure to subscribe to our channel and ring the bell so you don't miss out on any future videos. And as always, live today, plan for tomorrow.